When should you fire an investment manager? Hi, my name is Gary Mishuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I'm a little nervous making this video because I'm an investment manager and I manage a value partnership. And so talking about when you should fire as opposed to hire an investment manager is usually not a popular topic among my friends. But I think it's an important thing to talk about because I think that investors, including some very sophisticated ones, fire investment managers for all the wrong reasons, and then don't fire them when they potentially should be fired. So here are three reasons why you should fire an investment manager. Reason number one is if they haven't performed, and this is a key, but over a full economic and market cycle. So different strategies do well at different parts of the cycle. So right now, as I'm making this video in 2020, if you have a momentum trend following growth kind of strategy, or even just a growth strategy, you will look like a hero. You're awesome. You buy companies at 5 times revenue and they're being revalued by the market at 10 times revenue. You're amazing. Okay. On the other hand, if you're a value investor, things aren't looking so good in the market. Frequently, looks at your companies and say, you know, yes, the stock was cheap at 9 times earnings. Let's make it cheaper to 8 times earnings. That doesn't mean anything. Right? Conversely, in a rapidly declining market, value managers typically will do better than growth managers because they have investments that have lower expectations, and there is less hot air to come out of their balloon, so to speak, than the growth managers who bought companies at 50 times earnings and lose half or two-thirds of their money as those valuations come down to earth. That doesn't mean that value investing investors now are amazing, every single one, and all growth managers are terrible. What you want to do is measure an investment manager's performance over the full economic cycle. So you want to make sure there is a recession or downturn in the market sell-off in there. You want to make sure there's a fair number of mid-cycle years, and then the peak. And if over the full investment cycle, which is usually anywhere between 5 and 10 years, you don't see meaningful excess returns versus your opportunity cost, which for a broad equity strategy would be the total market, then you should fire the manager, because you know what, it doesn't matter how great they dress or how nice their slide deck is or anything else. If they can't actually add value, you should be with someone else or with a low cost index fund. So that's number one. If you should fire a manager if their performance doesn't add value over a full cycle. So number two is if they deviate from their process. So I think that investing is a very behavioral endeavor. And what I mean by that is, a lot of people know what they should do in theory, but many people actually have trouble doing that when the going gets tough and they're under a lot of stress. Let's say when their approach isn't working for a prolonged period of time. So the question you want to ask, and you want to see through actions, not through words, is this manager still sticking to their process? They hopefully explained their process to you and you liked it. You thought it was a winning process for whatever reasons. And now you want to see evidence that they're following that process. And if you see evidence to the contrary, that they're deviating from their process, then you should be very cautious. I mean, maybe they'll have some great explanation how they evolved. And certainly you want to allow room for learning, but usually learning is incremental and it happens slowly. So maybe it's a small part of the process that changes once in a while with continuous improvement. That's fine. But if it's very diametrically opposed, where someone, let's say, started as a value manager, buying distressed stocks, and now all of a sudden they're buying companies at 10 times revenue because they have figured out how to value high growth businesses, all of a sudden you should be cautious. There's a chance that this person isn't evolving, that they're just capitulating and trying to do what is working at the time. That's number two. So if the person's basically abandoning their process. And number three is if you realize that maybe you made a mistake and this person was never that good at the beginning. So sometimes people have very slick marketers, they talk a good game, but they actually can't execute. And you'll see that they're just not particularly good, even though they say all the right things. And that might manifest itself in that they're not looking at the right kinds of opportunities, if they're, or maybe the level of due diligence and research on each investment idea isn't really that great, or if they're taking undue risks and they're not understanding how to manage risk at the portfolio level. So any of those things are important, and maybe they kind of uh, sounded good initially, but you realize that even though they're following their process, they're just not that good, and that's okay. You can, if there's enough evidence that you should, by all means fire them, and no hard feelings. We all make mistakes. So those are the three reasons. I hope this video is helpful to you. If it has, please hit like and subscribe to my YouTube channel. Thank you, guys.